Are you looking for a small cap stock that could play a role in AI infrastructure or physical AI? We're going to talk about Ouster today.
That was a lot of buzzy hype words in there.
Trying to catch you before you go away.
Don't click off this video. We're going to talk about Ouster and why, after a bit of a pullback in the stock price following Q3 2025 earnings, which were good, pretty solid, why we're still interested in this one, why it's still part of our small bets basket.
Is it a buy the dip candidate?
All right. Ouster fits into primarily the last two bubbles in markets in our semiconductor industry flow, the tech equipment and devices, and they have software that governs their devices as well, but they're primarily fabless company. And here's a look at the supply chain for Ouster.
Casey mentioned Ouster is mostly fabless these days. Historically, we could consider them an IDM, integrated device manufacturer. They both designed and manufactured their LIDAR devices, but they have sort of outsourced more of that in recent years, especially after the Velodyne merger a couple of years ago. And so their primary contract manufacturers and assemblers are Benchmark Electronics and Fabrinet. So those are the two assemblers, and they source the wafers from a variety of different low-cost wafer fabs. Most of this stuff happens in Southeast Asia. For example, like the Benchmark Electronics Assembly Company, their assembly plant is in Thailand. Another notable thing here, Amazon is probably AWS is where they build their software and where they host their software platform that connects with the actual LiDAR. And as a result of the Velodyne merger a couple of years ago, Amazon holds a substantial amount of warrants in Ouster. Probably signifies there's a deeper relationship there on the cloud software and probably also in development of the products for end market uses. So Amazon might actually even be a customer for their robotics division and warehouse automation division. Other customers, there's a couple other notable ones here actually on the downstream customers. We thought we'd point out one in particular, Serve Robotics. That's actually a public relationship between Ouster and Serve. So the LiDAR on those Serve robotic delivery vehicles are powered by Ouster LiDAR. So that's interesting. Maybe you find that interesting, maybe not.
I checked out.
Let's take a look at some of the goals that Ouster has outlined for their business over the coming years. And we're going to analyze how they're doing with these goals with the help of our friends over at fiscal.ai, the sponsor of today's video.
All business management teams should communicate these types of milestones for their shareholders, and fiscal.ai's platform can be a great way to keep track of what those goals are and then analyze them using the visualization tools that we're going to show you here, like this one that shows the quarterly pace of revenue and year-over-year revenue growth rates, which is one of Ouster management's targets.
You can get 15% off any paid plan with the link here in our video, fiscal.ai/CSI. That's 15% off any paid plan, including their pro plan out there for you pros. Before we look at those charts, let's see what Ouster wants to accomplish.
They want to achieve 38 to 50% annual revenue growth, maintain their gross margins at 35 to 40%, and keep operating expenses at or below Q3 2023 levels, starting with the revenue and the revenue growth rate.
Obviously, this is the top of the income statement if we were looking at the quarterly report. So obviously that's where we'll start. And it also just so happens to be the best of these metrics. You can see in Q3 2025, another acceleration in revenue growth, up to 41% now year over year. So that's nice to see, still landing right in the middle of that long-term guidance for 30 to 50% revenue growth. But good to see the uptick in this metric, because the last quarter and actually even prior to that, they were below their long-term guidance. So it's encouraging to see that they have been able to accelerate that metric and get it into the mid-range of their long-term guidance and long-term goals. We would expect that this continues, and if not, maybe even accelerate a little bit more to bring the average up within that 30 to 50% target that they had called out.
Now let's take a look at their gross margin. So they said they want to keep their gross margin 30 to 40%, and they've been beating that goal of their gross margins. Last quarter, 42%, down just a little bit from the June quarter, 45.
Not bad for such a small company trying to scale up its operations. Another green check. Let's check these off mentally. Green check mark.
Now, how about their operating expenses? So the goal was to keep it at or below Q3 levels. So that Q3 is all the way on the left, September 2023. And their total cost operating expense was 38.8 million. And the most recent quarter, 40.9.
The last couple quarters, they had elevated operating expense, not significantly over and above the Q3 2023 level. Maybe this isn't a green check mark, but it's okay. It's passable. The last previous 4 quarters, 5 quarters, they had actually indeed kept it below. So that's good. Perhaps they can average this out again in subsequent quarters, because they do have some elevated operating expenses right now, which we need to acknowledge.
Increased R&D work on those next gen sensors, including AI model retraining expenses to improve detection and recognition capabilities. Seems like they need to spend money on this.
Absolutely. And we talked about this during the last update. They are rolling out new hardware and retiring some of the legacy hardware, especially the old Velodyne hardware, and pushing their customers towards these newer, higher performant LIDAR devices. And so obviously in tandem with that, you need to improve the software that goes with it as well. So elevated operating expenses, obviously the free cash flow, negative 20 million, a bit worse than we expected. It was good to see them scaling towards positive free cash flow the last 4 quarters prior to this one. But again, there's a lot going on with Ouster. These metrics can be kind of lumpy from one quarter to the next. Let's maybe not stick a big red X on this metric, maybe just, but not a green check mark either. A yellow question mark.
Let's go back to the balance sheet here. Cash on balance is actually improving, 244.5 million. And tell us about the ATM program for their shares.
It's another one of those very appropriately named ATM program, at the market program. But this is a program where a company has authorized itself the ability to sell new stock onto the open market to raise cash. And so that's why the cash balance went up, even though free cash flow and operating losses were a thing, very much a thing in Q3. They were able to more than offset that with the ATM program. But that means shares outstanding, the orange bar, continues to go up sequentially. So this has to be factored into the analysis as well. As Ouster scales up its business and perhaps one day, not too far into the future, they achieve positive free cash flow, you'll have to account for this dilutive effect of the ATM program. So this is definitely another key concern. Obviously, Ouster needs to scale. It needs to get bigger than it is. It needs to land more customers and deepen the engagements with existing customers, but that does come at a cost for shareholders right now. So as we move down that income statement and also look at the statements of cash flow, there are some concerns here, but such is life for such a tiny small cap business. Some valuation notes. This was from our prior update when we had the Q3 2025 guidance. And we talked about that little cheat that you can use for valuing a business like this that doesn't yet generate a profit. How do you value a company like this? Unfortunately, we're left with things like price to sales ratios, but that's kind of imperfect, right? It only helps if you're comparing the company to peers or other companies with similar operations to it and with a similar growth rate profile. So we dig a little bit deeper here, and let's run the scenario where we pretend Ouster can generate a 20% free cash flow margin today, and then stick a valuation on it. So we updated this after we have this Q3 update. and the Q4 guidance to close out 2025. Casey, what are we looking at now?
So for the revenue, they expect 39.5 to 42.5 million, which will imply a year-over-year growth rate of 32 to 42%. And then we've got the valuation notes there at the bottom, 47x enterprise value to free cash flow based on 20% free cash flow margin baseline. And that's pretending if Ouster was free cash flow positive, which, it's not right now, or 36x, assuming the same 30% sales growth forecast.
So obviously, Ouster is not free cash flow positive. Why would we use a metric like this, a made-up financial metric like this, to gauge the valuation of Ouster? Well, just a refresh from 3, 4, 5 months ago when we talked about this, the expectation is for a company like Ouster and its business model that when it scales up its revenue to a level where it's possible for them to be profitable, a 20% free cash flow margin is sort of the baseline expectation. So let's just pretend that they have the ability to get there. What would they be trading at today? This is why we kind of have to use our imagination and pretend Ouster has the ability to actually reach this margin and then value it accordingly. This is why we call these types of small bets in our portfolio a prove-it stock. You keep the position small, and as the company checks off the list of things they need to accomplish, you can maybe add to the position a little bit over time, but overall, it still needs to remain small, a very small part of your portfolio for the average investor, and then let it organically grow into a larger, more meaningful part of your portfolio organically as the company gets bigger, as the value of the business gets bigger because they're achieving those goals. What do you think? What do you think about Ouster?
I'm going to use my imagination and think about the valuation. I like Ouster. It's a small position for us, so I'm comfortable with that at this point.
Make sure you hit the subscribe button, and you got a sneak peek at one of our supply chains that we have over on our new website tool, the Semi Insider Research Platform. You can get access to that only with a subscription at chipstockinvestor.com.
Check it out, everyone. We will see you there and over on the Discord server. It's a package deal. You get both access to the supply chain tool and our fantastic community of long-term mindset investors.
See y'all again soon here at Chipstock Investor.